No one hates worse than having the market go against them from the time of entry. Now here's the rules to trading the Fibonacci numbers. First, find and draw your trend lines, your inner, your outer, your long-term trend line. This will help you to determine if you are in an uptrend, downtrend, or if a trend line has been broken, signifying a potential end of a trend. Use your Fibonacci tool on your software and draw your Fibonacci lines and find the extensions for profit taking. If you do not have software that has Fibonacci tools, call us up immediately. We'll get you with the right software. The Fibonacci tool is very important. Some softwares out there do not have the right extensions. So if you're having problems with that, give us a call. Look at the latest price swing. Find the anticipated trend line Fibonacci convergence bounce and look at a potential risk with your protective stop loss order. If you can't afford the potential loss, should the trade not work out, then stay out and do not trade. Pull out your trader's checklist, go over that checklist, create a trading plan, and trade that plan. Now what you want to do is activate your trading software, and when you activate your trading software, you'll start to prepare to enter the trade. The second thing we want you to do is pull out your trading form. We want you to keep track of everything on paper that you do, just in case your computer crashes, just in case the trading software crashes, just in case your electricity goes out for whatever reason. Keep track of everything that you do. Fill out your paper trading form. Put your date, the currency you're trading. We're trying to find a convergence, a Fibonacci number, and we're trading an uptrend. Now, you turn on your computer and this is what you see. You spot an uptrend. Before you move on, draw your trend lines. Let's see if you know how to properly draw your trend lines. Put the computer on pause. Draw your trend lines. This is what your trend line should look like. Lesson 5 focuses in on trend lines. Now we have an inner and an outer trend line. What our plan is, because of our Fibonacci's, is we're going to try to find a location where the market should bounce at a 618 trend line. So the next thing we're going to do is we're going to find the current swing, which is this low to that high. We have a low and a high. Now, our plan is to buy this 618 trend line bounce. Now the market's way up here. You can see that once again, price movement against time. As we eat up time, chances are the prices will fall and the trend line will rise, and when the two shall meet, that then becomes our convergence, or our area where we're going to get in. So now that we've drawn our Fibonacci numbers and looked at the current price swing, the plan is to buy the 618 trend line bounce. As I said, trading is all about understanding price movement against time. Time's going to eat up and prices are going to move. So as we eat up time, the trend line should rise, and we will get to a point in time where price and time match up with the 618. Now, I want to walk through a scenario here to where you have traded before and you've said, well, you know, I've missed out so many trades because I was trying to wait for the market to come all the way down to the 618. It didn't come all the way down to the 618. It only came to the 50, you know, or it came just a couple pips in front of the 618. And I'm tired of that. I've missed so many trades. And you just can't be patient. And so you buy now. You fear the trend will leave without you. You don't care about your risk, and you only care about your reward. Now think. You don't care about your risk, you only care about your reward. Trading is all about preservation of capital. Trading is all about risk versus reward. Under the rules of trading, if you trade now, your stop order is going to have to go at the last low. Look at the risk. 100, almost 200 pips. But you don't care because you're so confident this trade's going to work out. You just buy now. Now what I'm going to do is I'm going to be patient. I'm going to wait because, hey, look it, if this trade doesn't work out, I'll go find another one. But you can't. You buy now. Keep that in mind. You're buying now. Look at your risk. Now your plan is to enter now and take a ride because you think the market's real aggressive. You're going to take a ride all the way up to the 1.618 extension. You could be right. I may not get in on this trade. The fact is, neither one of us knows where this market's going to go. All we know is that the market could bounce here at this 382. It also could come all the way down and bounce all the way down at this 618 or 786. Heck, the market could even reverse and take out the trend line. But you don't care. You're real confident this market's going to go up, so you buy now. Let's watch what happens. You place a buy at the 382. You place your protective stop loss order at the last low and a profit limit at the 1.618 extension. Once again, look at your risk versus your potential reward. The reason I want to trade the 618 or 786 trend line Fibonacci bounce in the direction of the trend is because it creates a high probability that the market's going to move my way because I'm trading in the direction of the trend. And if it doesn't work, my loss will be much smaller than yours since our stop will be at the last low. Now look at how the market dipped and came down to the 618. It's doing what it naturally does. How are you feeling? You are now in the financial red. You are losing money. The market has come down to the 618 and started to bounce. Look at that. I've placed my order at the 618. I have been filled. I am now in the market. Look at the trend line is slowly coming up. My stop order is at the last low. Now, if you are chasing the market for profit, you cannot cancel and replace your order, your protective stop loss order, until the market makes a new high. If you entered at the 618 and the market begins to rally and you cancel and replace your order to the last low of the 618, then you could have a high probability of getting stopped out prematurely. If the market returns back to the 786 before it goes to the extension, you're going to get stopped out. And all you're going to do is pay the kitty. Now, let's look at this situation here. Let's just say you bought here at a 618. Market comes and it bounces right here at the 618. And boy, you're all excited. And you move your stop from this low to the 618 low. Look at how the market came back, tested that 618. Could have stopped you out early there. Be that as it may, it did return all the way back to the 786 and then bounced and went to the extension. If you moved your stop early, then you were stopped out and you were not able to take advantage of its natural move. Now, the 786 is the last level of hidden support or resistance depending on the swing. In an upswing, the 786 is the last level of hidden support. Do not cancel or replace your stop unless the market has bounced off the 786 and started to climb. Under the rules of cancel and replacing, you wouldn't cancel or replace anyway until the market has achieved a new high. 786 is the last level of hidden support. If the market takes out the 786 and exceeds 88% of the latest upswing, the market has a high percentage chance of reversing. Once the market has bounced at the 786, it is now clear to move your protective stop from the last low to the 786 low. Now let's look at this. You thought the market was reversing. You drew a downward trend line here. The market penetrated that trend line. It is now in an uptrend. The market rallied. You moved your swing from right here. Here's the 382, 50, 618, 786. You bought this 786. You anticipated the market to rally and go to the 1.27 extension. But instead, it U-turned and came down. Your stop was at the last low. When the market bounces at the 786, feel free, after it bounces and starts to rally, to move your stop to the 786 or somewhere a little lower than the 786. Because if the market bounces or rallies off the 786, U-turns and then comes down to take out the 786, chances are the market is reversing. And by canceling replacing off of a 786 bounce, all you are doing is saving money on your potential loss. So do not cancel or replace if it bounces at a 618. Only cancel and replace if it bounces off of a 786 or the 88%. Now, here's a trader's mantra I want you to buy into. I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. I will never trade without a protective stop loss. I will not chase the market. I will be patient. The market will meet the criteria of my trade or I will not trade. That must be your mantra. Now, the market has bounced at this 618 trend line convergence. It has come back and surpassed your entry. You were at the 382. I'm sure you're feeling a lot happier right now, but look at this is your entry. This is my entry. I stand to gain more profit. If this trade wouldn't have worked out, you stand to gain more loss than what I would have. My loss would have been much smaller than you. Now, let's move forward and watch what happens. Wow, the market rallies, does not take out the high, and it U-turns and comes all the way back down to the 786. Now that it's U-turned and hasn't gone to the extension of the 1.618 extension, it looks as though it's breaking the trend line and it could reverse. How are you feeling? You could stand to lose a lot of money if this trade doesn't work. Be that as it may, since it did come down and bounce at the 786, our original plan was to go to the 1.618, both of us, because it bounced at the 382, at least for you, you thought. For me, it bounced at the 618. Our plans were to ride it to the 1.618, but now it's U-turned on both of us and gone to the 786. Listen to the chart with your eyes. From where the chart has been, it will tell you with your eyes where it's going. Now that it is bouncing off the 786, I need to adjust my trade back down from the 1.618 extension to the 1.27 extension for profit taking. I am now not going to be able to make as much as I had originally anticipated. I was hoping to take the ride to the 1.618, but now I can only take a ride to the 1.27. If you listen to the market with your eyes and look where it has been, it will tell you where it's going to go. Now that the market went to the 786, you must adjust your limit to the 1.27 extension. Now, the market comes all the way down to this 786, and sure enough, this is what it does. It rallies, and it doesn't quite make it to the extension. It comes back, hits that trend line again, and bounces off of that trend line, and finally makes it to the 1.27 extension. We were both paid off. You especially got lucky. If you would have been patient, you would have made a lot more. Let's look at your gain compared to my gain. You entered right here. You made from here to here, but I made from here to here. Patience pays off. Figure out your P&L statement on the paper trading form, and once again, think how much you would have made if you would have been patient. Your trading software does figure out your P&L statement. One of the greatest things we did is a company has come out, worked with another company and came out with software that can allow you to paper trade with monopoly money so that you can acquire all this experience before you use dollar number one of your own money. Doctors operate on cadavers, don't they, before they operate on real people? Once again, fill out your paper trading form, do your paperwork, print out the chart, which is why this paper is only half a sheet. Print out that chart, file it in a notebook so that you can refer back to your education on what you did and your experience. Everyone, we are on slide number 160. Check your book against our slide to see if you're keeping up. Now, downswings work exactly the same and in the same numerical sequence as an upswing. Now let's look at a down price swing. The downswing starts at a high and ends at a low. Now when it starts at that high and ends at a low, as it is dipping, that is called a reaction. Look at this downswing, high to the low. Works the exact opposite. Downtrends are making lower lows and lower highs. Let's look at this downtrend. Lower lows and lower highs. Now in a downtrend, the market moves in a numerical ratio as well. Retraces back to the 618, goes to the 1.618. Then new swing starts, 618, 1.618. New swing, 1.618. There are ratios assigned to it. The 382, 50, 618 are assigned to the 1.618, and the 786 is assigned to the 1.27. Excuse me. Downtrend price swings and retracements. In a downtrend, everything is now flipped upside down. This is the start, that's the stop, this is the retracement, this has come down 100%, this is now retracing back 38%, 50%, 62%, 79%. If it comes all the way back to the last high, which is resistance, that would be 100%. Fibonacci ratios are hidden potential levels of resistance in a downtrend. As the market moves down, it should bounce at one of these Fibonacci ratio numbers. Now let's look at this downtrend. When the market reacts, dips, and retraces back to the 382 U-turns, it should go to the 1.618 or 162% of the original swing. Let's look at this. This is the downtrend. These are all the retracement values. These are all the extensions. This is the original swing. There is the 382 bounce, and this is the 1.618 extension. Look at how it went to the straight 1.618 extension and then aggressively bounced. Here is the original swing. It stops, goes to the 382. Do you see that, how it goes to the 382? Now, after it went to the 382, look at how it worked its way to the 1.618 extension, but look at how it bounced right there at the 1.27 extension. Everything is upside down. This is the original swing, 382, 1.618. Look at how fast it's moving. Okay? Now, remember, everything works in opposites now. Now that we're moving down, the 382 is moving very aggressively and fast. See how you can sell the low of the 382 bounce. Now, the rules are exact opposite. What you want to do is, as the market is falling, if it retraces back to the 382, bounces off that 382, you will sell that low. Now, if you sell that low, your protective stop loss order is going to be at the last high, which is where it bounced. It lends itself to a great equity management trade. Look at the profit. You'll get out before it hits the 1.27 extension, which was right here. Here's your profit. These make great day trades. Look at how the market went sideways. You now have a new swing. It came down, made a low, retraced back shy of the 382. You sell this low. When you sell this low, your stop goes at the last high. Here's your profit. Look at how it went to the 1.27 extension and bounced. This is your profit. When the market is fast and aggressive, it lends itself to a great trade. Now, downtrend price swings. When the market bounces at the 5.0, it should go to the 1.618 extension. Here's the original swing. There's the 5.0. There's the 1.618 extension. Look at how it bounced very aggressively there. The market's slowing down. Look at the downtrend price swing. When it goes to the 618 and U-turns, bounces, it'll go to the 1.618. Look at this one. Came down, went to the 618 and worked its way down to the 1.618. Look at how much time now it's taking to get to the 1.618 when it bounces off of 618. The market starts to slow down. Look at this swing. It came down, went to the 382, and very aggressively went to the 1.618. Now we're in a second swing, slowing down. See how it's slowing down? Now the market, when it goes to the 786 and bounces, it's only going to go to the 1.27. Look at the market, how it came down, bounced first at a 618, then went all the way back up to a 786, then worked its way down to the 1.27 and bounced. Indicators, look at these indicators. Indicators can play a great part in teaching you how to trade, giving you comfort in the number that you trade, and also spotting the direction of the trend. I like to short the market or buy the market when indicators are telling me it's still very bearish. So you learn a lot about that in lesson number 4, trading indicators. Market retraces back to the 786, it's slowing down. Now, I want to point this out. I opted to re-record this after the attack on America, mainly because on September 11th, terrorists attacked America. They attacked the World Trade Center, they attacked the Pentagon. When they did that, the world was in chaos. Everybody was skeptical, wondering what was going to happen. But even with all the chaos in the world, the financial markets moved in a Fibonacci numerical sequence. The currency markets never closed. The stock market closed for a week, and when it reopened, it responded in a Fibonacci numerical sequence. Now remember, I said a chart is a chart is a chart. Let's look at this. This is the Swiss franc on September 11th. They smacked the World Trade Center in the morning. When the terrorists hit the World Trade Center, the Swiss franc had a quick reaction traded against the dollar. As the Swiss franc falls, it is falling against the dollar, which means the Swiss franc is strengthening, the dollar is weakening. But as it moved in a Fibonacci sequence. Here's the original swing. There's the high, there's the low. The world is in chaos. No one knows what's going on. No one knows where terrorist attacks are going to happen next. Yet the currency moves in a Fibonacci sequence. Look at as it retraces. It goes straight to a 382. Starts to work on an extension, but instead falls shy of taking out the low. Retraces back all the way to a 618. Bounces. This is the 382, 50, 618. Bounces. U-turns. Goes straight down to the 1.27 extension. And then bounces at the 1.27 extensions and then completes the move on September 16th and goes to the 1.618, which is where it should go because it did bounce at the 618, bounces at the 1.618 extension, and then finally calms down a week later after the World Trade Center or America was attacked. Look at the Dow. The Dow moved within a numerical sequence. Prior to the attack, there was a swing that took place. There's the high, there's the low. It retraced back to the 618. On September 4th, the market started to move, and here would be the original swing of the original swing and the retracement. It should go to the 1.618, correct, of that swing. Now look at how slowly the Dow started to fall before the attack, and before the attack from this swing, look at how the market went straight down to the 1.618 extension. There it is. Oh, I'm going back up. Went to the 1.618 extension and then bounced right at the 1.618 extension. And then on September 11th, which is right here, the World Trade Center was attacked. The market did not open for 1 week. And when it opened that Monday morning, all of a sudden the market fell. The Dow fell. And where did it fall to? It fell exactly to the of this swing. Look at this swing right here. It bounced at the 382. It went straight within the first, this is an hourly chart, within the first 2 hours, it went straight to the 1.618 extension, bounced, U-turned, and slowly has worked its way down to the 2.618 extension, which is just shy of here. This is amazing. And that's the reason why I wanted to redo this lesson to show you. Look what the S&P did. Here was an original swing that was created September 27th. The S&P, look at how it went down. It came down. This is the 1.27, the 1.618 extension. Look at how it came down. It bounced at the 1.27 extension. It came down and formed a new swing. This is the high. That's the low. That's the 382. The market was closed. It opened up on Monday, the week after the attack, and from opening right where it opened, it immediately dropped to the 1.618 extension. Look at the blue. That's the swing. It opened. It fell straight to the 1.618 extension, bounced there immediately, U-turned, and continued to fall, working its way to the 2.618 extension. I'm just showing you the Dow, the S&P, and a currency. But look at how this even applies to the stock market. American Airlines. Look at American Airlines was falling in value before the attack. But then on September 11th, here's the original swing. Market retraces back shy of the 382, U-turns, takes out the low. Look where it went right after opening. It immediately went straight to the 1.618 extension and bounced and just held there during the trading day. This is American Airlines hourly. You know, ever since I discovered that the markets move in a numerical sequence, I have never ceased to be amazed that the markets work the way they do. Let's look at more into nature. Look at this river. This is the Quad Sabu River. Look at how it moves. Can you see the price swing and extension? Look at this price swing right here. Look at this retracement. Look at it. That is a 786 retracement of this swing. Look at how it moves straight and goes to approximately 127% extension and then retraces back. If you're ever flying in a plane, look down at rivers and then envision a numerical sequence as the rivers move. It's an amazing thing to view. Look at this mountain. Look at how the skyline of the mountain coming down. Look at the numerical sequence that it moves in. Comes down, retraces to a 382, goes to a 1.27 extension, then falls to the 1.6 extension, retraces, falls to another 1.6 extension, and even works within a trend line. Look at that, how each peak comes up and almost hits a trend line. Our world works within a numerical sequence. Now, in trading a downtrend, what we want to do is we want to try to find a downtrend line convergence with a Fibonacci number. And we want to sell that 618 or 786 because it offers the least amount of financial risk should the trade not work out. Now, in this trading exercise, let's go look for a 786, 618 trend line convergence, just like we did in the other trading exercise, except in the opposite direction. Activate your software. Let's face the facts. Every trader wants the market to move. Education should move that market in our direction, or at least put us in a high probability of success if the market moves. And the rules are exactly the same to trading a downtrend. It's just in the opposite direction. Let's go find all our trend lines. That'll help determine whether we're in an up or down trend. If we're in a downtrend, let's find the latest swing. Let's use our software. Let's find the last swing, and let's look for the anticipated Fibonacci trendline bounce. If the risk is too high, then pass on the trade and pull out your trader's checklist. Let's be wise and prudent and successful, and let's trade our plan. Now, you spot a reversal. You turn on your computer, and all of a sudden you draw all your trend lines. You draw an outer trend line, you draw an inner trend line, and you notice that the inner trend line has been broken. So now, from your education of the crown, you spot the reversal. You now see that the market is waving down. Look at this. Wave 1, U-turn, wave 2. And so what you do is you now draw a new downtrend line. And now our plan is, as the market retraces back to a 618 trend line of the latest swing, we are going to try to short the market. Now, here's that important information. When the inner trend line is broken, the market predominantly moves to the outer trend line. So for profit taking, we're anticipating the market to go down to this trend line right here. Here we spread our Fibonacci's. There's the swing, that high to that low. There's the 618 bounce right at the trend line. Our plan is to short the market at the 618. We want to get in before it, and we want to get out profit taking before it hits this trend line. If you find out there's a fundamental announcement taking place, you may want to perhaps cancel, replace this. Please look at lesson 16, which talks about trading strategies and what to do when fundamental announcements are getting ready to take place for maximum profit. We are shorting the market, which means we're going to sell high and buy low. Be that as it may, fill out your paperwork on your trading form. You will place your order now on your software, but keep track of it on paper so that you know exactly what you're doing and can refer back to it. Once again, the reason we want to trade a 618, 786 bounce in the direction of the trend is because if the trend or the trade doesn't work out, we lose very little. Now, if you are chasing the market for profit, you cannot cancel or replace your order until the market makes a new high or low. If you enter the 618 and the market begins to rally or react, and you cancel or replace your stop from the low to the 618 or the high, then you will be doing it prematurely. So let's look at the trade. Or let's understand this. See, here's the original swing. If we get in at a 618 and we move our stop from the high as it starts to fall, the market could create a Gartley, which is a less than 13, rally, come up to the 786, stop us out, and then we are unable to take advantage of this nice move. So remember, the 786 is the last level of hidden resistance or support. If the market takes out the 786 and exceeds 88% of the latest up or down swing, the market has a high percentage chance of reversing. Once the market has bounced at the 786, it is now clear to move your protective stop to the last high or low, depending on the direction you're trading. Look at how we spotted a downtrend. We shorted the 786 right here. The market bounced at that 786, U-turned, and took us out. If we shorted the 786, we need to move this to this last high, and this way we save money if the trade doesn't work out. Now here we go. Let's go back to our original trade. We sell the 618 end trend line. The market comes up to the 618, bounces. Now before you trade, decide whether or not you want to be a day trader or a position trader. Find out all your fundamental announcements. Remember, fundamental announcements make the market move very quickly. Find out those fundamental announcements. If there's a fundamental announcement, the chances are the market could come down very aggressively and even go through this trend line. Be that as it may, we have a reversal on our hand. We're anticipating to get in here. If you want to be a day trader for quick profit, you may want to get out here. If you want to cancel and replace this, you may want to get in here and follow it down. You could have a reversal on your hands. Be that as it may, right now we're trading a 618 trend line convergence. We're shorting the market. Look what happens next. The market goes down from our entry. Obviously, a fundamental announcement took this way down, broke through the 1.618 extension. If you shorted the market here at the 618, it came all the way down. Your order was filled. You got out with profit. This is your profit. If you're cancel replacing, you should now move your stop from this high to this high, even possibly come into this high. The market has gone to the 2.618 extension, and look at how it's just stalled right there. Your software will figure out all your P&L statement, but please do it by hand and print out the chart that you paper traded on and keep a record of what you're doing. Now, in closing, the best way to understand what you've learned about all these Fibonacci's and extensions and the natural things that it did was to write down what you thought you knew. Remember the exercise at the beginning? Let's go back at the beginning of your workbook. Let's find those charts. Look at what you wrote down. Look what your perception was then. And now, let's look at your perception now. This is what the chart looked like. Did you see this? See all the price swings and extensions? See the 1.618s and the 618s? This is chart number 2. Remember I said, write down what you think you might know about these? Is that what you saw? There is the original price swing, there is the retracement, there's the 1.27 extension. Because it's bounced off of 382, it's moving very fast. There's the 1.618 extension. Can you now see all that now? How about this one? We were in a downtrend. Look at all these Fibonacci lines. This is the 382, 50, 618, 786. That's 100%. This is the 1.27. This is the 1.618. This is the 2.618. Look at how the 2.618 matched up with the 1.618. You learn all about this in convergences in lesson 12. Did you see this? There are two great trading opportunities here. You could sell the low here with a protective stop at the last high. How about selling this low with a protective stop at the last high? Exit before your extensions. How about this chart? See the market, how it bounced at the 618? Did you see that? Did you see how it went up to the 1.27 extension first, then to the 1.618 extension? The market hits the 1.27 extension first many times before it makes its way to a 1.618 extension. How about this chart? Market's in a downtrend. Did you see this? Did you see how you now need to adjust your new trend line? You learned that in lesson 5. You see how the market moves sideways inside this original price swing because it came back to a 786, bounced at a 618 first. This is called a Gartley. The education on how to trade a Gartley is worth its weight in gold. You shorted the 786. Look at how it went only to the 1.27 extension and bounced. Now, here's the rules to trading the Fibonacci numbers. Let's all agree. If you're going to trade in the market, you've got to have an edge. You've got to educate yourself so that you know where to get in, you know where to get out, and you need to understand the why behind it. Let's all agree you've got to accept the fact that there are natural laws that govern our market. I've shown you this. It's the most amazing thing that I've ever seen. You have to enter these markets at the 618 and 786 and a convergence, because that creates a higher probability of a bounce and creates a higher probability of profitability. You need to enter the market buying that high or low at the 382 bounce. That gives a second trading opportunity when you understand the Fibonacci's. The market turns aggressive at that. And you need to accept that the markets don't go to the extension in our timetable. They go to their extensions in their timetable. We have to be patient. You also have to learn to create a trading plan and trade that plan. Now, did this lesson teach you that the markets are governed by natural laws? Did this lesson teach you that the markets work in a numerical sequence? Did this market teach you how to read a price swing and its extension? Did this lesson teach you how to find a Fibonacci number? Did this lesson teach you how to trade a 382 bounce and a 618, 786 trend line bounce, perhaps a convergence? Did this lesson teach you how to create a Fibonacci trading plan and trade that plan? Did this lesson teach you where to place your protective stop loss orders and financially protect yourself in every trade? If it did not, play back this lesson. Because of this reality, and look at everything you've learned in this lesson, now you can start to see why 90% of novice traders fail. Remember, successful traders will do what unsuccessful traders won't do. They'll educate themselves on how the market works. Losers pay winners. Winners are winners because they went about trading the right way. They didn't opt to try to get lucky, because there's only two ways that you can really pay for your education. One is luck, and if you make money from trading and don't know what you're doing, you just got lucky, and it'll only be a matter of time that you'll become unlucky. The tragedy in losing money in the market when you're trying to become lucky is this: you don't know how to earn it back. But if you go about properly educating yourself, if you go about working with a mentor, Market Traders Institute Incorporated and ForexTips.com, we are mentors, we're coaches. We take traders to higher levels of achievement. We even take experienced traders to higher levels of achievement. Working with a mentor and getting education on how the market works is like buying a map to a gold mine. There's two ways to extract gold: from a mountain. Obviously, if I said, boy, there's gold in them there hills, there's two ways you can go about getting it. You can take off running and just go kicking over all kinds of rocks hoping to find the gold. How long can you last? A week? A year? 10 years? How long will you stay there before you find a vein that can eventually lead to the mother lode? Or doesn't it seem to make more sense in buying a map so you know exactly where to go? Well, educating yourself how to trade, being mentored from somebody who knows what they're doing, is like buying a map. It accelerates the process of extracting the gold. And the greatest part about learning how to trade is if you lose money in the market, you now know how to earn it back. Don't ever forget this. When a man or when a person with money goes up against a person with experience, at the end of the event, the person with the experience ends up with the money, and the person that had the original money ends up with an incredible experience. Do not underestimate that statement. Let's face these facts. Every trader wants the market to move in their direction from entry. Look at how education on how the markets work allow you to improve those percentages and have the market move from your entry. Look at how much comfort you can have in the numbers that you have to pick when it's time to trade. There are 16 lessons on trading the Forex to help you learn how to make this kind of money. These lessons are predominantly on technical analysis. They are well worth their weight in gold. They come with trading exercises so you can practice. You can play them over and over again. Every trader needs to have a mantra. You need to abide by this mantra. The market must meet your criteria as a trader or you will not trade. That has got to be a large part of your trading mantra, style, technique, and belief. Remember, if the charts are not clear and they don't visually make sense, when in doubt, stay out. Because of the 21-day 3% rule, play this lesson over and over and over again so you don't forget it. If you just play this once and set it aside, within 3 days you will have forgotten 80% of everything I have taught you in this lesson. And over the next 18 days, you'll only retain 3% of it. Play this lesson over and over again until you understand the information. Go and practice with our software. Sign up for forextips.com. Go into our chat room. Learn from experienced traders. Participate and learn how to trade before you put dime number one of your own money. Now, on behalf of everybody here at Market Traders Institute Incorporated and forextips.com Incorporated, on behalf of your financial portfolio, on behalf of your family that allows you to invest your hard-earned money, we would like to thank you for investing in yourself and for purchasing this lesson. Successful people do what unsuccessful people won't and can't do. What are you going to be?